Hello everyone, my name is Fardila Adila, matrix number 104120 from Group VE VEE. Today, I will presenting our research proposal entitled Factors Affecting Stock Market Liquidity in Malaysia. First, I will explain the background of our study. Stock market liquidity refers to how easily investor can buy and sell shares in the stock market without causing major changes in share prices. A highly liquid stock market is important because it helps investors trade more efficiently and encourage investment activities. As a result, it supports capital formation and contributes to economic growth. In Malaysia, stock market liquidity has experienced significant fluctuations from 1980 until 2024. Based on World Bank data, the value of stocks traded as a percentage of GDP ranged from approximately 4.21% to 79.90%. These fluctuations suggest that stock market liquidity may be influenced by several macroeconomic factors. Therefore, it is important to investigate the factors that contribute to these changes. This slide presents the three macroeconomic factors examined in our study. The first factor is interest rate spread. When borrowing costs increase, businesses and investors may reduce their investment activities because loans become more expensive. This can lead to lower trading activities and reduced stock market liquidity. The second factor is inflation rate. A higher inflation rate reduces consumers' purchasing power and creates uncertainty regarding future investment returns. As a result, investors may become more cautious, which can negatively affect stock market liquidity. The third factor is exchange rate. Exchange rate movement influence foreign investment and capital flows. When the exchange rate becomes unstable, foreign investors may be less willing to invest, which can reduce trading activities and liquidity in the stock market. Therefore, these three factors are expected to play an important role in determining stock market liquidity in Malaysia. Next is the problem statement. Malaysia's stock market liquidity has fluctuated considerably between 1980 and 2024. This situation is important because low liquidity may reduce investor confidence and make the market less attractive to both domestic and foreign investors. Although many previous studies has examined stock market performance, most of them focus on stock prices, stock returns, and market indices rather than stock market liquidity itself. In addition, the findings of previous study are often inconsistent. Some studies found significant relationship between macroeconomic variables and liquidity, while others reported different results. Therefore, there is a need for future investigation using long-term data to better understand the factors affecting stock market liquidity in Malaysia. Now, these slides present the research question and objectives of our study. There are three research questions. The first question is, what is the relationship between interest rate spread and stock market liquidity? And the second one is, what is the effect of inflation rate on stock market liquidity? The third one is, what is the impact of exchange rate on stock market liquidity? Based on these questions, the general objective of this study is to investigate the long run of macroeconomic factors on stock market liquidity in Malaysia. The specific objectives are first, to evaluate the relationship between interest rate spread and stock market liquidity. Second is to determine the effect of inflation rate on stock market liquidity. And the third one is to analyze the impact of exchange rate on stock market liquidity. Lastly, I will discuss the significance and limitation of the study. This study is significant for three groups. First, policymakers, because the finding can assist them in formulating effective monetary and financial policies. The second one is investor, as the study can help them make better investment decisions and improve risk management strategies. Third, researchers because this study provides additional evidence regarding stock market liquidity in Malaysia. However, there are several limitations. The study uses secondary data obtained from the World Bank. It only focuses on three macroeconomic variables, namely interest rate spread, inflation rate, and exchange rate. The scope of the study is limited to Malaysia only. And lastly, annual data may fairly capture short-term fluctuations in stock market liquidity. And other than that, methodology also is the limitation.
Good evening everyone, my name is Nur Khairunisa and today I will be presenting Chapter 2 Literature Review for our research entitled Factor Affecting Stock Market Liquidity in Malaysia from years 1980 to 2024. So, in this chapter, I will discuss the previous studies that is related to our research, the theoretical frameworks, the conceptual frameworks, and finally the research gap that justify this study. To begin with, stock market liquidity is one of the key indicators of a healthy financial indicators. It refers to how easily investors can buy and sell shares without causing significant changes in stock prices. A highly liquid stock market improves market efficiency, attracts domestic and foreign investors, and support long-term economic growth. So, from previous study have shown that macroeconomic conditions play an important role in influencing stock market activities. Therefore, these studies focuses on the three macroeconomics variables, namely the interest rate, number 2 is inflation rate, and number 3 is exchange rate. It is to examine their long-run relationship with stock market liquidity in Malaysia between years 1980 to 2024. So, moving on. This slide summarizes the findings from previous studies regarding the relationship between the three selected macroeconomic variables and the stock market liquidity. The first variable, interest rates. Previous studies have found that interest rates influence borrowing costs and investment decisions. Lower interest rates encourage investors to invest in the stock market because borrowings becomes cheaper. In contrast, higher interest rates encourage investors to shift towards fixed income assets such as bonds and bank deposits, reducing stock market trading activities. So, Malaysian studies also consistently reported a long-run relationship between interest rate and stock market behavior. However, the findings remain inconsistent regarding the strength and direction of the relationship. Second variable, which is inflation rates. So, from previous studies shows that inflation affects purchasing power and investor confidence. So, moderate inflations may indicate economic growth, while high inflations creates uncertainty and discourage investment activities. Malaysian evidence confirms that inflation significantly influenced stock market development. Nevertheless, previous findings remain mixed because researchers use different methods and measurement. The last variable, which is exchange rates, from previous studies found that exchange rates influence international trade, foreign investment, and investor confidence. Stable exchange rates generally encourage investment, whereas exchange rate volatility reduces trading activities due to higher uncertainty. So, from Malaysian studies, consistently identifies the exchange rate as an important macroeconomic determinant. However, relatively the few studies specifically examines the impact on stock market liquidity. So, next is theoretical framework. The first theory used in this study is efficient market hypothesis (EMH), which is developed by Eugene Fama in 1970. So, this theory stated that stock prices quickly reflect all publicly available information. Therefore, whenever there are new macroeconomic information such as changes in interest rate, inflation, or exchange rates become available, investors will immediately adjust their investment decisions. These changes in investor behavior subsequently affect the trading activities and stock market liquidity. Therefore, the EMH explains how public economics information influence market behavior. So the second theory is arbitrage pricing theory, APT, developed by Stephen Ross in 1976. Unlike other financial theories that focuses on only one factor, this theory, APT, suggested that stock prices are influenced by multiple macroeconomic variables simultaneously. In this study, the three macroeconomic variables are interest rates, inflation rate, and exchange rate. Changes in this variable will affect the investor expectations, trading behavior, and ultimately stock market liquidity. Since this study examines the combined effect of several macroeconomics variables, APT serves as the main theoretical foundation of this research. This slide presents the conceptual framework of the study. This framework is developed based on the two theories mentioned before, which is efficient market hypothesis (EMH) and arbitrage pricing theory (APT). So there are three independent variables, that is interest rate, consumer price inflation rate, and third is official exchange rates. So this variable is expected to influence the dependent variables, which is stock market liquidity. In this research, stock market liquidity is measured using stock traded total value as percentage of GDP, which reflect the overall trading activity in Malaysia's stock market. Next is research gap. Although there are many studies that examine the relationship between macroeconomic variables and the Malaysian stock market, there are still several important research gaps that still remain. First and foremost, the most previous studies focuses only on stock market, stock returns, stock prices, and overall market performance instead of stock market liquidity. Second one is in different studies using different methodologies and periods and variables, resulting in inconsistent finding. Third one is there are only limited numbers of studies that measures using liquidity using a stock credits total value as a percentage of GDP. Finally, there are very few studies that combines effect of interest rates, inflation, and exchange rate using a long-term dataset covering from years 1980 to 2024. So this limitation provides the motivation for conducting this study. So, how this study contribute to the previous limitation? This study aimed to address the limitation identified in the previous research. So, the first one is focuses specifically on stock market liquidity rather than stock return or stock prices. Second one is it uses stock credit total value as a percentage of GDP, which provides a broader measure of trading activity. Third, it investigates the combined effect of three major macroeconomics variables within a single research model. Finally, by analyzing annual Malaysian data from years 1980 to 2024, this study is expected to provide a more comprehensive evidence on a long-run determinants of stock market liquidity in Malaysia. Thank you.
My name is Fifi Natasha binti Azhar, number metric 104189. I will be presenting my research framework regarding the macroeconomic determinants of capital market liquidity in Malaysia. Let's start with the empirical literature review. When looking at interest rate, the dominant consensus in finance established a clear inverse relationship with the stock market returns. Academics like Olokoyo et al. 2020 point out that rising interest rates increase borrowing expenses, which directly compresses corporate profit margins and discourage new investments. This also trigger capital outflows from equities into fixed interest securities. Within the Malaysian context, Ng et al. 2018 found that central bank policy rates significantly drive negative domestic stock price movements, while structural models show that this interest rate shocks lower equities value due to limited systematic liquidity. Next, for the inflation rate, time series evidence heavily favors the proxy hypothesis over the traditional inflation hedge theory, proving that inflation exerts sustained negative pressure on long-run stock growth. Olokoyo et al. 2020 demonstrate that consumer price inflation erodes purchasing power, impairs corporate cash flow, and escalates operational risk. This aligns with the contemporary Malaysian evidence by Vi et al. 2023 who documented that inflation maintains an adverse, statistically significant connection with our share market operations over extended periods. Finally, regarding exchange rate, Vi et al. 2023 identified a powerful long-run relationship showing that Malaysian equity indexes are highly vulnerable to external currency shocks. Interestingly, the directional impact varies. The May 2019 discovered that domestic currency appreciation can structurally uplift local stock index by attracting foreign direct and portfolio investment. On the other hand, Olokoyo et al. 2020 observed that exchange rate shocks act as a significant co-integrating factor, making currency value absolute essential for capital market forecasting. Now that we understand the empirical background, let's move on to the specific hypotheses that anchor this study. I have formulated three core hypotheses to guide the empirical analysis. Hypothesis 1 states that there is a statistically significant negative long-run relationship between the domestic interest rate spread and stock market liquidity in Malaysia. The economic rationale here is that a wider interest rate spread indicates increased credit frictions, elevated corporate borrowing costs, and compressed commercial lending efficiency. These higher borrowing parameters depress corporate valuations, driving institutional capital flight away from equity instruments and into secure fixed income alternatives, which ultimately reduce stock trading volumes. Hypothesis 2 posits a statistically significant negative long-run relationship between the consumer price inflation rate and stock market liquidity in Malaysia. In accordance with the proxy hypothesis, accelerated consumer price inflation is expected to maintain an adverse relationship with liquidity because rising consumer prices increase direct operational input costs for corporate entities. At the same time, it also deteriorates real disposable income, which reduce retail market participation. Lastly, hypothesis 3 expect a statistically significant long-run relationship between official exchange rate measured in LC local currency units per US dollar and stock market liquidity in Malaysia. Because this metric is scaled as LCU per USD, an increasing numerical value actually means a depreciation of the Malaysian ringgit. Currency depreciation can catalyze foreign portfolio equity liquidation as investors try to circumvent exchange losses, theoretically leading to a negative impact on domestic stock market liquidity. To test this hypothesis, I have designed a methodological framework which I will explain on the next slide. On this slide, we look at the research methodology and design. This study adopts a quantitative, causal, and empirical approach based on a time series econometric methodology. We chose this over static cross-sectional techniques because a time series approach allows us to carefully consider the non-stationary nature of finance-related data and effectively model long-run co-integration among our variables. The target population for this research focused entirely on the macroeconomic context and capital market structure of Malaysia. The sampling unit consists of secondary macro data collected on an annual basis. To ensure strong statistical power and robust diagnostic ability, the dataset captures an expansive historical horizon consisting of annual observation spanning a full period of 45 years, specifically from the year 1980 up until 2024. This long-run time frame provides sufficient observation and yields the adequate degrees of freedom required to conduct highly rigorous time series analysis and high diagnostic regressions. Let's break down how these variables are exactly operationalized and measured. This slide outlines the variable specification and data sources. All data series used in this framework are extracted from the World Bank World Development Indicators Data Bank. This guarantees maximum international standardization and data reliability. Furthermore, in alignment with established empirical practices by Olokoyo et al. 2020 and Vi et al. 2023, the financial indicators are transformed into natural logarithmic form where necessary to stabilize variance, normalize data distribution, and minimize potential heteroscedasticity. As displayed in this framework table, our dependent variable y is stock market liquidity, which is operationalized using the total value of stock traded as a percentage of GDP. This serves as a robust indicator of structural capital market liquidity and transaction volume. We have three independent variables grounded deeply in capital market literature. First, the interest rates structure IR measure via the interest rate spread. This evaluates borrowing friction and commercial bank profitability margins that feed into equity values, following Olokoyo et al. 2020. Second, the inflation rate (INF) tracked via consumer prices annual percentage. This matched the strategy of Vi et al. 2023 to highlight direct consumer price changes that pressure equity markets, rather than using a general GDP deflator. Third, the exchange rate (ER), proxied by the official exchange rate in the local currency units per US dollar. This allows us to observe the international competitiveness and capital flight dynamics that heavily dictate domestic index behavior as agreed by Demir 2019. That's all for me. I will pass to the next presenter, which is Nofara Azrani. Thank you.
Moving forward, I will present econometric model selection and specification. We are using autographic distributed like ARDL approach. We use this ARDL bounds testing approach to measure macroeconomic impacts on stock market liquidity. This method is ideal for 44 observation and works where the variable are one integrated of order 0 or integrated of order 1. Stock market liquidity and the exchange rate use a logarithmic form, while interest rate, spread, and inflation rate stay in level form. This relationship is modeled using this unrestricted error correction model UECM. This is our model specification that we use for our research proposal. We execute this analysis in eViews using a rigorous five-stage testing procedure. First, we run ADF unit root test to confirm no variable are I2, which would invalidate the model. Second, we select optimal leg length using AIC or SIC benchmark to avoid serial correction. Third and fourth, we use a joint F test to check if our statistic exceed the upper critical bound, proving a long run relationship. Finally, we verify that the error correction term is negative and significant, proving the market successfully corrects back to equilibrium after external shocks. To guarantee our results are valid, consistent, and reliable, we subject the model to five crucial diagnostic checks. The Brusher got fair test for autocorrelation. The white or brush pagan got fair test to heterodacity. The Jarku-Bera test to confirm normal distribution. The Ramsey reset test to verify correct model specification. And finally, Jusum and Chusum square plots at a 5% level to ensure parameter stability across shifting economic cycle. To conclude our research proposal, the required 45-year database is readily available on the World Bank website. All diagnostics tests will be run using eView via existing university license, focusing on three key macroeconomic variables, ensure the project fits within the economic terms. This study use public secondary data requiring no clearance for human subject, and finally data is used exactly as provided with a strict 13 similarity limit of under 30%.